one way, but
Today's market call is presented by CME Group, where risk meets opportunity, and FactSet, financial data and analytics powered by tomorrow.
tell you what, it is a glorious day on the East Coast as we're sitting here today on October 22nd. By the way, this is market call 1 p.m. on the aforementioned East Coast. It is just beautiful outside, probably, I don't know, mid 70s, maybe a tad cooler, but no humidity. I mean, this is why you live in the Northeast for fall days, like very autumnal out there, Dan.
It is very autumnal. You should be wearing like some oranges, some browns, that
Yes.
sort of thing.
Yes.
By the way, Guy, you're in front of a green screen. Maybe Amanda could like put up some sort of weather pattern, something like that. Maybe a little bit of a map, and you can kind of speak to it. That would be cool. You just gave us a nice little rundown. And speaking of rundowns, Guy, let's throw it up there. Let's get into it.
Let's get into it.
Because I feel like you and I have not been doing this in this manner in a little bit. Last Wednesday, we had a travel day. On Thursday, we did a live market call from the Robinhood Summit, which was a whole heck of a lot of fun. We did that with Steph Guild. She is their head market strategist. But Guy, let's talk about this, man. Volatility ahead. Today seems like one of the first down days. We're not down by a whole heck of a lot. And I know that Amanda put this one in there. How high will rates go? But didn't you and I were talking about this? The great rate debate. Didn't we think that should have been the bullet there or no?
A great rate debate. I mean, you take your pick. But Amanda, listen, she's a pro. So she just wants to go straight with the question mark. And she wants us to effort to answer that. By the way, we'll do a little audience Q&A if time permits. But yeah, we have been on the road a bit. We're going to be on the road in November for a few days as well. We'll give you a heads up when that happens. By the way, Dan, what we like to tell folks is if you're not subscribing to the Risk Reversal YouTube page, please go and do it now. Apparently, of the folks that watch, half of them have not subscribed. So we're trying to reach 100K, 100,000 subscribers by the end of the year. And we are fast approaching. But as they say, Dan, we need your help. So slam the shit out of that thing or whatever people do.
It's the subscribe button. You could also like it. You could rate it, review it. You can leave comments. By the way, we love our comment section during the market call. So just kind of give us shout outs. We'll give you guys shout outs, questions, comments, concerns. We will get to some questions.
Sure we will.
Today. Guy, let's look at these S&P E-minis. It was interesting right out of the gate. I know you wake up early. The first thing you do is you look at the futures where they're trading. I think they were down like 30 bips or so. But if you look at that range over the last week, we're just kind of banging around, like 25 handles, 30 handles, that sort of thing. Maybe it's a little wider on some days. We drew a little bit of an uptrend. That's the August low to the September low. Feels like maybe we're going to touch that uptrend, but that wouldn't be, I don't know, what is that, 20 handles from here, Guy?
I think that's fair. I think that little uptrend line is intact. I mean, if this is a static chart, by the way, but if we were to draw a trend line from the November low and then touch the August low, the third point, if my eye is not incorrect, the third point would come in right around the 150-day moving average or so. So Amanda may be able to effort that in real time. But what I'll tell you is, there's a longer uptrend that's been intact for almost a year now, and that third point would come in right around where the moving average is. Now, I'm not suggesting we're getting there. We've talked about that for quite some time. Obviously, the first obstacle would be to sort of get through this mini uptrend here, but we'll see. What I find really interesting, though, yet again, is the way the market continually works off that early morning, weakness, and just by mid-afternoon, it starts to do the grind again. And what we're seeing here, that's all against a backdrop, by the way, of a VIX, off its recent high, but still elevated around 19 or so, Dan.
Yeah. And, there's also another line to be drawn if you want to just kind of look at that kind of horizontal line from those highs in July, Guy. That's about 57.50 in the futures. Wow. Look at your eye. You are correct, man. You attacked that November low to the August low.
I mean, it's pretty, I'll say this, Dan, about my ability. I'm not very good at very many things, but there are certain things that I'm good at. For whatever reason, my eye can actually see that line before it's been drawn. And as I mentioned, it's going to come right in around the 150 days. So the stars are aligning on that front for sure. Anyway, please continue.
Yeah, and again, that uptrend, you see where it gets you to. Maybe that's somewhere in the tune of 56.60. We're at 58.84-ish or something like that. And if we just want to do the math, if you were to kind of get back to that uptrend from the highs, that's about a 7.5% decline. And so let's just talk about this. You've been mentioning this VIX that's kind of stuck here, either side of 20. Right now we're at 1870 or so. One of the things that we've mentioned on a couple of occasions is like, it's not normal to see a VIX that elevated relative to, and maybe Amanda can pull it up here, relative to the average over the course of the year, a year where we've made 47 new all-time highs, which is, I think Amanda was looking into it last week. I think on years, in the last 50 years, Guy, when the stock market has made a new high in a year, I think it averages maybe 20 some new highs or something like that. So you can get a sense that we're almost double that. And if you look and see, other than that move in August that we thought was a bit fugazi in the VIX, you see an average move that's in the low teens. So here we are, we're stuck in the high teens. Is it signaling to you that we're going to have a little bit of a downward volatility period?
Yeah. So normally I would say yes, and I will still say yes. I think it's somewhat mitigated by the fact that, what is it, in 14 days or whatever, it's 15 days, there's a presidential election coming up. So I think part of the reason, not the entire reason, the VIX is a bit elevated from these norms we've been seeing over the last couple of years is predicated on the back of this election that's coming up. And maybe people are just trying to position themselves for some sort of tail risk into that. With that said, to answer your question specifically, yeah, I do think it sort of augurs another move lower. And, we said it in late summer. We had Katie Stockton on Fast Money. I think Tower Matheson was hosting, and she said her work suggested volatility was ahead. Now, I agreed with her, but I don't think anybody thought we'd see the VIX move up to 60. But with that said, she was right. And what I said in the week or so afterwards, I think that was sort of round one. I don't think this is over. And again, her work suggests that once you start to see vol enter the picture, it typically lasts somewhere between 6 and 9 months. So you could start to do the math, and that gets us into early next year. So I do think there's going to be another round higher in the volatility index, which almost by definition means there's a draft lower in the broader market.
Yeah, and we talk about this a lot when we're looking at single names in earnings, and we talk about how implied volatility, the price of options gets elevated largely because the lack of certainty about the outcome, right? And so investors are, often hedging up. I think that's what you suggest as far as the broad market, the S&P futures here. But it's interesting when you think about bets and you look out to the curve and you look at options, the way people are positioned, and you start to say to yourself, well, there's a large expectation that volatility, at least through the measure of the VIX, is going to come down after the election. Now, there's a whole host of things that could cause the election not to be decided in early November. And, if that was the case, then you're going to have a VIX that remains elevated, because at the end of the day, with an S&P just 1.5% off its all-time highs, and who knows where it's going to be in 2 weeks, Guy, but you might as well get hedged up because you have an S&P that's up 22.5% on the year already.
Yeah, I think you're doing yourself a huge disservice if you don't do something, if you don't move your feet a little bit. And to a certain extent, I think that's what we're seeing now. There's this old expression in TV. Amanda's an expert in the TV industry. You don't want to bury the lead, and we're not going to do that, because I do think the lead today and yesterday, and by the way, over the last couple of weeks, although the market's starting to wake up to it, comes in the form of yield. So throw this up real quick and let's take a look now. I think one would say that, maybe we've reached the level where yields should start to stabilize and maybe move off a little bit. So you've had this huge move from basically 355 or so at its low. I think that's how low we got. Currently either side of 4.2%. That's a pretty significant move in a very short period of time. And I think the market's waking up to the fact that, hey, wait a second. I thought the Fed was lowering rates. Meanwhile, literally since that day, yields have done nothing but go higher. And I think the market is trying to figure out why that is. I think I have a quasi handle on it, but the market is dealing with it now, Dan.
Yeah, so maybe Amanda can pull up the 2-year treasury. So the move has not been as violent. It kind of bottomed out, same level that you're talking about, 355, double
Hmm.
nickels there, guy. That's probably what you call that, right? 3.55. Here we are, we're kind of stuck at 4%. You have the yield curve that you've been talking about has become uninverted, right? To the tune of like 18 and a half or so. So does this reflect to you some of the the trepidation, or whatever the scenario is about what the Fed might do at their meeting, the next meeting? And let's just look at that, what the date is
Yeah,
of
throw
that.
that up.
It's
The Fed
November 7th,
Watch
right?
tool, the CME Fed Watch tool, and let's sort of discuss what I think is going on. But again, it doesn't matter what I think. It really comes down to what the folks watching think. But we all have our views. So this is mine. As much as people want to say the move higher in 10-year yields is on the back of the economy strengthening or showing signs of life, what I've thought it is and what I continue to think it is. And by the way, when I hear from Paul Tudor Jones, who was on Squawk Box this morning, sort of reaffirming my belief system, and then throw on top of that Stan Druckenmiller, who is now, I think his portfolio is 20% short the bond market. What it speaks to is a concern about debt out there. And not that we're going to default. That's not my point at all. But the market is going to demand a higher rate of interest to buy our debt. And by the way, it's not just the United States that you're seeing yields go higher. I mean, there are other developed economies as well, most notably Germany. So we're seeing it around the edges. Yields are going higher, and they're either going higher for the right reasons or the wrong reasons. And I think they're going higher for the wrong reasons. And you're smart to point out that 2-year really is not moving. The 2-year yield really should not move if you think about it. That's the only thing basically the Fed controls. Everything else is at the perils of the marketplace. And I think the market's starting to sniff out, regardless of outcome of election, it's inflationary, in my opinion.
Yeah.
I think the bond market is trying to figure that out and come to grips with it.
Well, it's a great point you make for some of our listeners, some of our viewers. So if the Fed Watch tool here from our friends at the CME is pricing in a near certainty of a 25 basis point cut on the November 7th meeting, that's why you have the 2-year kind of stuck here, to your point, right? But the 10-year is saying something very different. It's saying something about everything that you've just mentioned here, that these are broader concerns about the debt, the deficit, spending, right? Like all that sort of stuff. And so you would see that on the longer end here. So again, I don't think it makes it any easier for a lot of folks to kind of think about how that affects their stock, portfolios and the like. But one thing I would mention is that, when the Fed signaled that they were going to start raising interest rates in late 21, all these, what they call long duration assets, primarily, equities that were trading at high valuations, or they were unprofitable, or they were crap like SPACs, or they were crap coins, you know what I mean? That sort of thing. They all got murdered, in 2022. So I guess the question you have to ask yourself is that if the Fed was kind of one and done for whatever reasons, you know what I mean? What happens to equities that are trading at extended valuations? We know that our main man, John Butters, he tracks this very closely over there at FactSet in his Earnings Insight blog, with a 21.5 S&P, that is far greater than the 10-year average. I think it's, just below 19, guy. The 5-year average might be a little above that. And so at some point with rates, if they're stuck here or they actually look like they're going higher, that should affect equity valuations at some point.
One would think, and it's interesting, I didn't take the economics. I was out that day in college, but if you were to throw on your economy hat and take a look at what it may be going on, you're starting to see the beginnings of a decoupling between the short end and the long end. And the decoupling is I'm of the belief, and again, I'm not suggesting I'm right, but the Fed could walk in tomorrow and do some emergency 50 basis point rate cut. And that obviously would impact the front of the curve. And then you'd say, well, that means 10-year yields are going to go low. I don't know if that's necessarily the case. And I could see a scenario where the TLT actually sells off more on the back of the move like that, which would further steepen the yield curve, which, as Elizabeth Young Thomas will tell you, is the exact wrong time historically. It's not the inversion that gets you, it's the re-steepening. So there's a really interesting dynamic going on in terms of the yield curve and what it's signaling. Again, I think the optimist will say, you know what, you're missing the boat here. It's because the economy's on strong footing, things are normalizing. That may be true. I think the other is true. And, again, if you're short bonds, the reasons don't necessarily matter. But if you're short bonds and then trying to figure out what's going on with the economy and then furthermore the equity market, it absolutely makes a huge difference.
Yeah, and that's why earnings season, I think, is so important. On a day like today, we got a little bit of your Goodfellas. One dog looks one way, the other
Mm.
looks the other. And what do you want from me? I mean, we could take a look at like a General Motors that is just breaking out of this massive, base, and margins were better than expected. Like there's a lot of things going on there that you'd probably really like, especially if you were optimistic about the U.S. economy. I mean, look at that breakout there, right? And then on the flip side, there's a GE. They had a miss in their aerospace division, and it was disappointing. And so you have that stock getting murdered to the same extent that this stock is rallying. So once again, the earnings picture right now is as clear as mud. I'm looking forward to hearing what Texas Instruments has to say, guys. Here's a semiconductor stock that sells into industrials. They really don't have an AI play at the moment. There might be some kind of talk of what happens as it relates to the industrials and how they're investing in this. But that is pretty fascinating. Look at that 150-day average, guy. It kind of bounced in that spring level. It bounced in early August. And here we are right at that level. And again, there was a nice little consolidation going on there. So I just bring that up because of some of the divergent price action that we have right now in single stocks and maybe even some sectors that we're going to get to.
All makes sense. I think historically GM might be a good barometer of what's going on in the economy. I don't know necessarily if that's the case. I think a lot of this GM move is predicated on some of the things that are GM specific in terms of operationally and some of the tailwinds now that they may be enjoying, but I don't necessarily know, just my opinion, if it's a tell on the economy. With that said, if we talk about rates, we have to talk about the dollar, and just this won't seem like a big move in terms of from 100 to 104 ish, but when you look at a dollar or the currencies in general, this is actually a very big move in a short period of time, and it obviously mirrors what we're seeing in yields, which makes sense. So here's another concern that I think people should start to look towards or for, and I'm not suggesting it's going to happen, but it may start to happen where yields continue to go higher, and at some point yields decouple from the dollar and the market starts to sniff something else out. So if you see yields continue to sort of go higher, but at some point the dollar turn and starts to go lower, that's not going to be a healthy situation, Dan. And we actually had talked about that a couple of years ago. I had a saying for it. Perhaps you remember?
No.
Yeah, you do, Dan. Come on. Think about the time of year we're in. It's about to be Halloween.
Boo.
Think about Shakespeare. Come on, Dan.
Oh, careful what you wish
brew,
for.
a witch's brew, witch's brew.
All right.
Dan,
you're
not focused on me right now. That's okay.
No, it's okay. But I think your point is that the dollar move is confirming what you think about rates and where they go. And I think that's the most important thing. And you also talk about decoupling. This dollar started rallying when expectations for rate decreases kept on going in the markets. And so I think you made this point about guys like Paul Tudor Jones. Again, I think you used the term legendary. So that's, he is one of those guys, a big macro trader. Stan Druckenmiller, of the Soros Fund Management, and went out on his own, I want to say like 20 years ago. I mean, these guys don't make too many big mistakes. They come on CNBC or they write, they're at conferences once a quarter-ish, maybe twice a year tops. And they're not these sorts of people who go with the wind a little bit. They make big proclamations. They make big bets in macro markets that are hard to move around. But they're kind of confirming that your thought process that for a whole host of reasons, there's a little bit of a witch's brew happening there.
Mm-hmm.
Maybe there's a little careful what you wish for. I don't know, Guy. I just wanted to throw those both out there.
No, it's all good. So just keep an eye on at some point, if the dollar starts to sell off with yields going higher, that's going to be interesting. But the next thing we have to talk about is this crude move. By the way, you actually had a trade on the back. You shorted crude. You go back and look, basically within a day of that peak to the 150-day moving average, and you saw a pretty precipitous decline there. We talked about lowering stops, so that played out really well. But again, crude, just when it looks like it's on its horse and you have all these tailwinds, something sort of comes up and bites it into you-know-what, and that's been going on. I mean, this goes back to December. of last year. I mean, you can go longer term and you see, I mean, there have been fits and starts for quite some time now in crude. And, as Carter will say, have a lot of movement up and down, but basically we've gone nowhere now for the last couple of years.
Yeah, we were looking at this on the short side. I think, just above 74. We kind of, brought that stop down a little bit, and stops in general, they can be something that, they can be a bit, manageable, if you will. Right. And so one of the ideas, especially with futures, is like, you can take little short, or little small losses, use those stops, but don't be afraid to get back in, especially if you're somewhat convicted. So this is one that I would continue to sell on rallies. I think the demand picture just does not look particularly great. The dollar move, there's a whole host of things here, guy, but we'll keep tracking that one. All right, let's bring it to the stock market here, because this is like one of my favorite times of year when we start getting into earnings season. You and I track a lot of these names pretty closely. Try to read as many of the transcripts as possible. We try to drill down a little bit on kind of what one company says, how it might affect another company, in the like here. But we start a little bit with the sector level. And, when you look at some of these home builders that are getting hit just in the last 2 days, as rates are going higher, you see mortgage rates going higher. It's a pretty interesting chart. You had that breakout, guy. There was a lot of banging around and a lot of volatility. Go back to late July, you know what I mean? Where it looked like, rates were going lower, but there was a growth scare. And you look at that round trip of that move, right? And I think that was some earnings in mid-July that kind of took it to new highs, but look how quickly it came back. Now it's held that uptrend from those July lows, but it's sitting right on it. And you see that 150 day, which is about 110 or so, which is also sort of that breakout level that we had in July. So how are you thinking about this? Is it just a rate trade? Is there anything else as it relates to home builders, that are interesting to you from a fundamental standpoint?
I think it's definitely rates have a lot to do with it. I also think that at a certain point, it's an unemployment move as well, understanding that the rate is actually gone a little bit lower, but also understanding that I think we have the most people in history working multiple jobs now. The pushback on that would be it's a different economy now. You have an environment where people can work multiple jobs, and that may in fact be true. But I think the larger component of that is people working multiple jobs because they have to. So you throw all that in the mix, and you say at a certain point it's going to start to affect the housing trade. Now, I don't like the XHB, the way it's constituted and the way it's constructed. So let's look at, for example, Pulte Homes. If Amanda can pull that up, PHM, all these home builder stocks, PHM, DHI, Toll Brothers, are going to look similar. But when you see a move of this magnitude today, I mean, that's a very significant move. We haven't seen a move like that to the downside, Dan, in quite some time. So you obviously saw that big range yesterday. You see the move lower today. I think yields have a lot to do with it, but I also think at some point everything's going to catch up. Now, people will say correctly that all these stocks are cheap on valuation. Valuation in the home builder world, specifically these four names that we talk about, have nothing to do with it. It's all about sort of, you're trying to look out into the future and look at the landscape. And at least today, for the first time in a long time, the stock is trying to, I think, tell a story. So you got to watch these things over the next couple of days for sure, because we have earnings. I think DHI might be next week. And I think you have Toll Brothers as well. So just keep an eye on these, Dan.
And so you would not be a buyer until we kind of get back.
No. And Carter Worth, by the way, just respectfully, he had a note, I think, last week, and I think he talked about it on Fast Money last night, where he's looking to short the home builders, the home builder stocks. So
yeah,
just keep that in mind.
All right, we got to talk about this group. This would be the banks. We know that they kicked off earnings season. Nearly all of them traded, really well. They either got to or back to 52-week highs and made new ones, or they were able to kind of hang out near those highs. We talked about this on Market Call right before it broke out. We're like, this is one of the best looking charts in the market if you were to actually have it confirmed, right, from decent news on the earnings front, decent visibility and guidance. But Guy, when you look at this and you look at it like on a day like today, where rates are moving higher, that's the main story. Bank stocks have worked when the perception was rates are going higher. They worked when big rates are going lower. Even some of the big money, money centers that had, some questionable issues with their kind of mark to markets, like treasury portfolios and the like. And so lower rates was meant to be good, but they're acting well in a higher rate environment. Talk to me about this, because it doesn't make a lot of sense.
Yeah, I think what the market is looking at in terms of the banks, obviously they're taking some of their cues from earnings, which I understand. I think to a certain extent, maybe they're taking some of their cues from valuations, which price to earnings for some of these is still somewhat reasonable if you're trying to sort of justify being long something on the back of valuation. I also think, and this is where it gets a little misguided, I think the market is taking its cues from this re-steepening of the yield curve, which a lot of market participants or whatever machines are out there will interpret as bullish for banks. The flip side of that coin is loan origination, loan demand, all those different things. One has to wonder what type of environment we're headed towards if things are slowing down as meaningfully as I think they will. So I get the knee-jerk reaction here, but I don't necessarily think this is some panacea for banks right now. So I see this breakout. We were right to sort of highlight that. Those tops were 115-ish or so in the KBW. We're there for a while. We got through it. My sense is you do a back and fill and retest what past resistance becomes support. And then we'll see what happens if and when we get there.
Yeah, let's look at the KRE. So this is the regional bank index, and this is interesting too, Guy. They look very similar, right, on a near-term basis, but had that little bit of a breakout and then kind of giving it back a little bit. So that's interesting price action. Maybe Amanda can kind of pull it out to a 5-year, because one of the things that you and I had been talking about in Market Call, I think early last week, is it got back towards that breakdown level in the Silicon Valley, situation, and that consolidation that we've been in. That's a nice little flag here. Is that something you might look to kind of pick at a little bit to kind of play for that breakout, especially if we see some sort of stabilization, at least in the movement yields and maybe in the markets that
this is going to look obviously a lot like the IWM for obvious reasons, because I think a large component of the IWM are small and regional banks. But with that said, I think the same thing holds true here. I mean, if you think about it and just sort of take it a couple more steps, the most economically sensitive banks are the small and regional banks, one would think. And, if you have a view on the economy that things are slowing and that the consumer is sort of stretched, it's going to be a very hard environment for these companies to do well. So again, I get why they're rallying. A lot of it's been on the back of valuation and people sort of searching for places they can reconcile in terms of valuation. In the absence of bad news, these things start to levitate. But I guess the question you have to ask yourself, are they out of the woods, or is there another round coming? Obviously, what I think. I think there's another round coming.
Yeah. Here's one that with rates going higher, and I would think that both of these names historically, or these sectors, would have some difficulty here. One of them is the XLP, that is the consumer staples. All right. If you think about, what we've just seen here, this is a really nice 45-degree angle, right? And so if rates are coming down, you think some of these higher yielding names would look more attractive. So let's see how the staples act in this earnings period. I think there was already some weakness in some of the names that are in this ETF or in this sector. But again, it's a really nice chart. Now, this is the other one. We don't have to spend too much time on this guy, but XLU, utilities, used to work really well in a lower rate environment, but this has obviously a lot to do with power consumption from the generative AI trade. So again, it's interesting to see when some of these sectors, guys, this is not too different than 25 years ago when, the internet was going to start, benefiting all these other industries. And that's when they were calling them these old economy stocks. Remember that? And so valuations got kind of juiced up. I don't think this is that different. And again, who knows what the power consumption needs will be for generative AI in a year, 2, 3, if it's just not a technology that has the uptake that many people are expecting right now.
We've talked about this now at length, how utilities are starting to, they are benefiting on two sides right now. They're benefiting on the valuation side and obviously the value side, and their defensive play, and they're obviously benefiting from this power demand seemingly that's non-ending. Now, that's the XLU, but we've talked about this stock for a while, and this is sort of the poster child for it. Amanda, if you could pull up a 5-year chart of VST, I only mention this, and this is a stock that we never mentioned on Fast Money for 17 years, and we obviously didn't mention on Market Call, but we've talked about it recently. And again, this was a stock that did nothing for years. And by the way, that's not an indictment. I mean, that's just the way these things trade. And then it started to sort of catch something in the fall. I think it was sort of a sniff of the AI trade. And you see what's happened basically since the spring. I mean, it's a pretty remarkable move in a very short period of time. And this on the energy front, Dan, is sort of the poster child for everything you just talked about. The question is it sustainable, or has it gotten ahead of itself? So all these things need to be taken into consideration. By the way, while we're at it, just throw these adjacent trades. We have a Dell chart if you want to throw that up. And this is, again, not an indictment of Dell, but the round trip that Dell's done since the fall, I think, is pretty interesting as well, Dan. If you look at a huge move spring into the summer from the fall, and then the subsequent move lower. And now here we are at this sort of small uptrend line. So let's see how this plays out too.
Yeah. And so just to be clear, this is a theme we've been talking about, again, for a very long time, right? So if you're going to build a large language model, if you're going to train it on the internet, right? So you're going to need NVIDIA's high-end GPUs that go into Dell and Supermicro's servers, that go into the data centers that are run by the hyperscalers. It's Microsoft, it's Google, it's Amazon, it's Oracle. There's a few others playing there. And so, like you see this ecosystem, there's memory that goes into the servers from Micron, you know what I mean? So again and again, so it's all kind of related. I think at some point, I think we're not going to have, or we're going to have a move that's not so different from, 2000 to 2001. That doesn't mean the NASDAQ's going to go down 80%, and from the May 2000 highs to the October 2002 lows. But when you see the sort of sell-offs that we've seen in some of these names, you can just see it in the Dell, right here is $180 in the late spring, and it got down to what, $87, so that was a 50% decline. Same thing for Micron, same thing for AMD, same thing for Supermicro. Now, obviously some of these stocks have rallied back a bit, but even NVIDIA, right? The one that is it's like you can't move this thing. It's a juggernaut. NVIDIA had a 35% sell-off. Now, obviously, it just made a new high, and that's a very impressive sort of thing. Let's see if it can hold above 140, Guy.
Without question, Texas Instruments reports after the bell. You have the implied move here. We're right at an uptrend line, which I think is interesting. We'll see. 5% move in either direction. Logic suggests the move is probably higher given the sell-off we've seen over the last couple months, and the fact that we're probably right up against this 150-day moving average. Thoughts on Texan, Dan?
Yeah, and again, we kind of hit it a few minutes ago. Like, this is not one that you're going to have, like they're not making AI PCs, they're not going into servers that are training the models, this sort of thing. So when you think about their exposure to industrials, you say to yourself, hey, look at a day like GM today, you know what I mean? Like, maybe that's something, I'm more interested in hear what they have to say, because if you go back and you think of some of the guidance that we heard from ASML, they were telling us that the weakness was not in AI, it was in other sorts of things, whether it be, smartphones or PCs or some other areas. So it'll be really interesting to see if some of these companies kind of confirm a little bit. And again, ASML, they make the machines that make the chips. So, again, this goes back to the ecosystem. Guys, should we take some questions?
I got them right in front of me from Compounding Capital, and we addressed this, but put up the question: is there any concern about deficit? Seems like both candidates could cause a spike in inflation with gold and 10-year Treasury moves. Yeah, I mean, that's what we talked about with Paul Tudor Jones. We talked about Stan Druckenmiller. We addressed that without question. And yeah, I think to a certain extent, when you're seeing some of these ex-S&P things, the way they're trading, the bond market, the commodity market, I think suggests exactly that. I think the market is sniffing it out. From John Hutton, questions for the guys. It's been mentioned on the show before that ETFs aren't necessarily the best way to play gold. Yeah, John, I've said a number of times that the GLD is not a particularly well-constructed ETF, and that if gold works the way I think it will work, there's a scenario where GLD actually completely underperforms, and it's just sort of what it's backed by. Danny Moses has talked about this a number of times. PHYS, the Sprott Physical Gold ETF, is a much better way to do it. We've talked about it vis-a-vis some of these mining stocks. We've mentioned Agnico Eagle. Man, if you can throw up an AEM chart over the last year and a half, you'll see a pretty astounding move in this stock, making an all-time high as opposed to a Newmont, which is probably still trading at about a, I don't know, 60% or a 30% discount to its prior all-time high. So yeah, the GLD I think is the worst place to be if gold plays out the way I think it might, Dan. Another quick question.
Let me just make one point, Guy,
ahead.
is that, I think this is important. The GLD is up 24% on the year, and the gold futures, they're up like 33%. You know what I mean? So there's something, it speaks to, I guess, what you're saying about the construction of it. And then if you look at these futures here, you go back and you say to yourself, okay, let's trade these with stops. You know what I mean? Like this has been, bottom left, upper right. There's been some really nice consolidations. You keep moving your stop higher. And, this is the way to play this sort of thing. You get a meaningful pullback. I don't know. Maybe it has something to do with the dollar. Maybe it has something to do, with central bank activity. Who knows? But this thing has been working. You've been saying, back up the truck on any pullback. And I think the differential between the ETF and the futures is notable.
Steve B asks, can you look at silver in the near term? And we've talked about this, and I think Carter had a note, I want to say last week, but for the first time in a while, silver's starting to basically catch up with the rest of this commodity trade, the rest of this precious metals trade. And it's been doing nothing for a while. And if you do a longer term chart, you'll see this thing is getting on its horse. And I think there's a scenario where silver continues to do this stealth rally that nobody seemingly will talk about until everybody's talking about it. It's nowhere near, well, I shouldn't say nowhere near, but it's probably, if you look in terms of its all-time high, there's probably still another 40% or so to go before we get to its all-time high, as opposed to gold, which is basically trading at an all-time high. So I definitely think silver is in play here, and you can see it from that chart right there. Adam B is messing with me. Thoughts on the L in your clam? Yes, my clam has had a great run, but today Lockheed Martin getting beat up on, I think, on sort of a revenue miss. Huge backlog in Lockheed Martin. In my opinion, this just looks like a, take profit, sell the news. It's going to consolidate. It's had a huge run. I think it probably sifts in, I don't know, somewhere around 550 or so, and then I think it has the next leg higher. But this has been a monster in terms of LMT, Dan.
Yeah, and again, I mean, if you're not long this thing, you like some of the things that have been driving it over the last, few months, 6 months or something like that. It's sometimes really interesting to see just how stocks kind of can overshoot to the upside. Like look at that last move that it's retraced, Guy, just in the last kind of month or so. I mean, it looked like it was getting a little too euphoric. And that being said, on Friday, you see that we made a new all-time high, so I think this is one of the moves. It doesn't take much of a disappointment to get a lot of folks after a huge gain like this to kind of head for the doors at the same time.
That's what I think. That's exactly what you're seeing. This is from Chris. Thoughts on McDonald's, the stock, and then thoughts on the chicken Big Mac. Okay. If there is in fact something called a chicken Big Mac, I mean, McDonald's should shutter every franchise in the United States and abroad. I mean, that's just embarrassing. Okay. Big Mac has nothing to do with chicken. They want to call it a chicken, whatever, knock yourself out. But don't start substituting chicken for beef. That just does not fly. In terms of the stock, made a new all-time high. If Amanda can go a little longer term, you'll see there was this little bit of a double top. We basically finally got through it. I think what you're going to see is a back and fill to those prior highs, which is right around 302-ish. But this looks really good to me. Finally have the moving averages working in an upward trajectory. Valuation maybe a little bit stretched, but the same way it's McDonald's world, the same way it's Walmart's world, I think it's McDonald's world as well, Dan.
Yeah, no doubt. I mean, it's a fascinating stock that was making new 52-week lows right in July. And we've been talking as far as the consumer is concerned, as a sort of this trade down a little bit. And maybe that's some of the thing that kind of got this thing going again off those lows. It is interesting, though, it was a match low from late last year. So from a technical standpoint, and I got to say the other thing, and this is something I kind of was thinking about this weekend, this is a company, and you said, these franchises, a lot of local stuff going on there, but it seems like in Pennsylvania, they've really extended kind of some of their hiring sort of parameters, They put to work some convicted felons this weekend, which I think is pretty cool there. You know what I mean? So, I like what McDonald's is doing generally. I don't mind. I don't mind the chicken Big Mac. I think it's a nice, a lot of folks who used to eat those back in the 80s, like you used to, a little variety. That's the spice of life, Guy.
Yeah, disagree. By the way, the move lower in McDonald's over the summer was on the back of the CFO talking about, and I had never heard McDonald's say this, but they were actually seeing their customer was getting squeezed and they were concerned. And I think that was sort of the sell first, ask questions later. But that's it, Dan. I have other questions, but as you can see, I'm getting ready to head into New York City for CNBC's Fast Money. As mentioned earlier, please subscribe to the Risk Reversal YouTube page. It helps us a great deal. And we're now in the 13th year of Market Matrix, Dan, if you want to just opine quickly.
Yeah, I see what you did there, guys. So every day, our team, we curate probably about 10 stories or so. We summarize them in a perplexity model, and we get that text and we put it into a voice bot, which is also AI. So it's basically an AI generated, or we use AI to generate them. And you get in under 10 minutes a really interesting summary, not read by Guy and me. So you don't have to listen to us anymore, but it comes out shortly after the close, and we think it's a very useful tool. I actually listen to it just in case I miss any of these stories, Guy, that you put in, that you've curated. So we're really excited about it. Please go subscribe to it in your favorite podcast store, rate it, review it, share it. That's how people find it, Guy.
Rangers are in Montreal tonight playing the Canadians. Canadians sort of like the Yankees of the NHL in terms of their dominance throughout history. But they are not your grandfather's Canadians. The Rangers should make short work of them. We'll see. Yankees play Friday. Another team plays Friday. That's the Dodgers. You know who doesn't play Friday, Dan? The Mets. Sorry about that. But that's it for me, Dan.
All right. Thanks, everybody. We'll see you tomorrow with EYT from SoFi. That'll be fun, Guy.
See you later.